Bloomberg Audio Studios. Podcasts, radio, news. And Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
What I learned from our next guest years ago, which shocked me and still to this day amazes me, the largest supermarket chain in the United States is Walmart. I never would have guessed that. And now that I think about it, of course it is. Jen Bartashus, she's the one that kind of enlightened me on that one. She's Bloomberg Intelligence Senior Analyst. She covers the retail staples and the packaged goods companies. So, Jen, I'm thinking in a world of tariffs, and I'm worried about, if I'm a retail investor, kind of the margins my retailers like a Walmart might have. Having the grocery store business as a traffic driver, that's got to be a good thing. Did we see that in Walmart's numbers today?
Yeah. Hi, Paul. We absolutely saw that in Walmart's numbers. Their growth in consumables and grocery, mid-single digit growth. That means people keep coming back to Walmart to buy their staples. And, that's a foundational type of thing, because for Walmart, as they get these customers doing that regular repeat shopping and coming in consistently, it really bodes well for how well they'll be able to retain those customers once all of this market volatility fades, and people become a little less price sensitive.
How does Walmart just really in general raise the pressure for competitors? We have Home Depot and Target reporting out soon. How do you think they will fare?
Well, I think that Walmart is really uniquely positioned because it arguably has the best view into mainstream America consumer of any retailer out there, because they touch such a huge number of households. And so when somebody the size of Walmart says that even their scale isn't big enough to fully offset tariffs, the read through on that is for other retailers who are smaller and who have bigger exposure to imported goods is rather dire, because Walmart is the one that is probably best positioned to weather it because of its scale. But that just means for the smaller guys, it's going to be a really difficult battle, and that there's going to be a lot more price that has to be taken and a lot more operational maneuvering to try to stay competitive in that particular set. So Target has a lot of discretionary exposure. Home Depot, Lowe's, they both do as well. So, it could be a difficult season for those retailers.
All right, full disclosure, and John Tucker knows this, my last job in this illustrious career of mine will be as a greeter at Walmart.
We hope to see you
That
there.
would be fun. I'll visit Walmart.
I've never been in one because they don't have them near me. It's weird.
Route 70 in Brick. That's going to be
That's too far.
The next stop here on this one. Hey, Jen, you mentioned it, and that's kind of where I wanted to go. I can see Walmart dealing with higher tariffs and pricing because they're Walmart. But how about the mom and pop retailers out there on Main Street, USA? How tough is it going to be for them, do you think?
It's incredibly tough, Paul, because the mom and pop retailers, it's usually only a handful of employees. It's a very set type of inventory that they carry. They don't necessarily have the ability to flex in and out of different product categories to lessen the impact of tariffs, because they're usually known for a particular type of product, which is why their customers come to them. And so, they're very reliant also on getting goods either directly or through third parties that are imported. And so there's just very little room in their operations to be able to offset the power of what's come, or the pricing that's going to come with these tariffs. And we've heard anecdotally small businesses that are just saying they've had to lay off employees already. There could be greater ramifications, in terms of unemployment and things if small businesses are impacted to a large degree, should this tariff situation persist for longer than we're expecting.
Yeah, you bring up a good point, because you have CFO John David Rainey saying the range of outcomes is pretty, quote, extreme. And it is. How has Walmart, have they hinted on how they're preparing for it? I mean, we know that they're a good barometer of the U.S. economy and they're really, really huge, but they must still be impacted by tariffs.
Absolutely. They definitely will be impacted. But part of where their advantage is that the company has been investing for some time behind technology like AI. And AI has across retail, but especially for those retailers who've had the time and the balance sheet to invest in it, gives them a lot of flexibility in their tools for predicting what their need is going to be and for responding quickly to changes in their supply chain. So, that investment in AI will actually pay some dividends and probably help them navigate the tariff situation more easily. And again, that goes back to the smaller players who don't have that kind of technology support or haven't been able to make those investments. It will be harder for them to maneuver in that environment.
So, Jen, if I'm Kroger or some big, grocery store, and I don't know, Kraft Food comes in and says Cheese Whiz is going to be 10 or 15% higher price to you, Kroger, because of tariffs. How does that conversation go? Who's got the leverage there? Who eats it? Who takes it? How does that go?
Yeah, it's usually a combination of a couple of things. So the first thing is that because the grocers all have private label programs, they are very, very well informed on what cost of ingredients are, which ingredients are being imported, packaging costs. So when a counterpart from a packaged food company comes to them and says, we need to increase prices because of X, Y, and Z, the retailer can call them out if they don't see the same pattern that they're being given as an excuse. Now, then there's a collaboration where ultimately both the retailer and the packaged food company want to, increase the volume sold and make sure that their products are getting in the hands of customers. So when it comes to pricing, usually there can be a bit of a sharing in terms of cost. But most of it does fall onto the packaged food company itself. And that comes in the form of having to do promotions, or offering discounts and things like that to make sure that their products are actually moving and that they're generating turnover and that they're then getting some profit out of it.
Jen, thanks so much for joining us. Always appreciate it. Always learn something. Speaking to you, Jen Bartashus, Senior Retail Analyst for Bloomberg Intelligence. I mean, Jen had a real career at Bloomberg. She was managing departments, managing a bunch of people in global data. And then we asked her, 15 years ago, hey, come to Bloomberg Intelligence. We think you'd be a really good analyst. And she did come over. She accepted, and she's been great. And now she's one of the leading voices on retail. So another success story coming out of Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's check in with Mari Shor. She's a senior equity analyst at Columbia Threadneedle. She's up in Boston. We love to talk to her when we get the retail sales numbers because she really spends a lot of time looking at the retailers, the consumer, that kind of thing. So a real helpful voice to us. Mari, what did you make of the retail sales here? I mean, I guess there's some noise here about, tariffs, and did that impact kind of how consumers are spending money these days? What did you make of the retail sales number today?
Yes, thanks, Paul and Isabelle. Thank you for having me. Absolutely. You said it better than I could have. The tariffs are definitely creating some monthly noise. When we look year over year, the growth has been a little more consistent and actually showed acceleration in April versus March. But on a month over month basis, we did see softness in April versus March, given the pull forward that we saw in March ahead of some tariff-driven price increases that the consumer anticipated in some big ticket categories like autos. When I look and really step back and just getting off of Walmart's earnings call, I think their tone on the consumer is very consistent. Obviously, tariffs are creating a lot of noise in the spending trends, but in their words, the consumer is still very focused on value and speed of delivery. And that is what we've been seeing for years now coming out of the pandemic.
I'm glad you brought up consumer because for Walmart, we saw traffic, which is the number of shoppers, less of a boost to the figure than ticket. What does that tell you? Yes. That maybe there are less shoppers, but they're buying more expensive things or at least higher amounts of tickets?
Right. So that could either say they're coming in less frequently, and when they are in, they're buying a lot more, right? They're stocking up more, or to your point, they're buying more expensive things. But we did see relative weakness in their general merchandise category. We saw their, food category is up mid-single digits. Health and wellness was up high teens. A lot of that is GLP-1s. And general merchandise for them was actually down slightly, which is worse than what we saw in Q4. And so I think it suggests that the consumer is, coming to Walmart for their stock up trip, which is typically what we've seen with Walmart. But, I think a lot of that intra-week spend, those like fill-in trips that we talk about, I think that the consumer may be doing less of that just given their general caution and uncertainty over what tariffs are going to do to their spending ability in the future.
Hey, Mari, when you speak to the retailers that you talk to across your coverage area, what's the feeling today in terms of how much they want to pass through to customers versus how much they're willing to kind of take in their margin here?
Yeah, it's a great question. And it's so interesting seeing like the commentary from the retailers versus what we see in the stock market is very different, right? I mean, the stock market is acting as if these tariffs are no big deal. We got some resolution, things are going to be fine. Then you listen to the retailers. I mean, you listen to Walmart today. They're talking about, starting now, there will be less product on shelves. They're going to do all they can to try to protect pricing and their value position in faster turn categories like food, but there's certain categories like toys, electronics, even some of the textile categories like apparel and soft home, where it's going to be really hard for them to absorb the full impact of tariffs. So I think, the 10% rate for a lot of companies is a lot more manageable. When you talk to them about the 10% we see globally ex-China, they seem to feel a little bit better about that. I think, the 30% in China is still too high. And the margin levels and a lot of the categories that come out of China are very low, and they just do not have the ability to absorb that pricing themselves, share it with their vendors or their vendor partners, their manufacturing partners who are also operating on very low margin. And so it's inevitable that some of that is going to have to come through to higher prices. It's just a question of, I think what the retailers are really they're really struggling with now, how to think about that trade-off between price and volume. I mean, during the pandemic, as everyone took pricing, we did not see the kind of elasticity of demand that you would typically expect to see when prices move up. And I think how the retailers manage their unit inventories is going to be a huge area of focus for them and for investors during this really volatile period.
One thing that also caught my eye with Walmart is it said its online business posted a quarterly profit for the first time. Are you seeing the same trend across the board? And what does that tell you?
No, this is very Walmart specific. We have seen in the e-commerce space, Amazon and Walmart taking incredible share. And so when you listen to Walmart, and they've been kind of alluding to the fact that they were nearing this inflection in profitability for some time, I think it's really coming from two things. It's coming from the scale that they are now seeing as that business has grown so much. And also they've talked about how consumers are increasingly willing to pay for delivery, for expedited shipments. So if you're making dinner tonight and you realize you forgot a certain spice, you could pay $5 to have Walmart deliver it to you in the next hour. And in those cases, the consumer is more willing to pay for delivery. And I think that's something Walmart had not expected. But it is a key, I think, part of the reason why they are able to achieve e-commerce profitability. They also have, of course, the benefit of the growth in the marketplace and advertising and fulfillment services and membership, all of which are higher margin and are really starting to move the needle for them, as we see with Amazon. But I think Walmart and Amazon are in a league of their own as it relates to what they're seeing in e-commerce, both in terms of the growth that they're putting up in that business and the profitability that they're able to achieve.
Mari, thank you so much for joining us. As always, Mari Shor, Senior Equity Analyst for Columbia Threadneedle Investments. She's up there in Boston, and she joined us via that Zoom thing.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
President Trump making lots and lots of news in his trip to the Middle East. Lots of economic deals being announced, big dollar amounts as well. All that is good for the companies involved, but he does call out Apple. Tim Cook not there with him, as Jensen Huang is of NVIDIA, also suggesting that Apple should stop moving iPhone production to India. What is that all about? Anurag Rana, technology analyst for Bloomberg Intelligence. He covers Apple. He covers all this tech stuff for us in the burgeoning tech capital of Chicago, Illinois. Anurag, Apple Computer, they're trying to diversify their supply chain, maybe get a little bit less reliant on China, taking some of that over to India. Does a president not like that?
Yeah, we just heard that, and in fact, looks like Apple cannot, catch a break right now. We thought that the U.S.-China deal would probably put a lot of those fears to rest, but it just looks like that he's not happy with Apple moving some of that iPhone facilities to India. Now that is the case because frankly speaking, you do need a low-cost labor setup. You do need really large factories and the amount of labor to assemble some of these products. Remember, even in an iPhone, the chip can come from a high-cost region, but the assembly of the phone, cannot be done in a high-cost region. So I think they are in a bit of a jam as to what to do, because we have Bloomberg News reported that they wanted to double their capacity in India to ensure that they don't have to pay the high tariffs rate coming out of China. But let's see what Apple's does to counter that. Our best gut feeling is that they will ramp up the investments in the U.S. and perhaps target more on the higher margin items such as chips or really expensive Macs. But it'll be tough for them to do this on the iPhone level, frankly.
But that's the thing. Apple already promised to hire more workers domestically here in the U.S. and spend $500 billion over the next 4 years. So you think they will need to add more to that?
Either they need to add more to that or support some of the local manufacturing, perhaps in the chip capacity, or explain to the president how they're doing it in the U.S. A lot more benefits to, the local workers, because, for President Trump to call him out, out in the open, does put him in a tough position right now.
What is the Apple strategy here? Because again, we think of some of the quote unquote China exposure. The company that comes to the top of most people's list is Apple, because they get 20% of their revenue from China. Their supply chain is fully enmeshed in China. And I know we've talked to you, for the last several years about how they can diversify here. What is the reality in today's world for Apple?
See, the reality is the higher value products. So let's say the chip that they do or they make, those are all designed in the U.S. It's made by TSMC. Those plants have been shifted, some of them to Arizona. So the higher value products can be done. But frankly speaking, think about it, lower, whether it's an AirPod or whether it's just an assembly of the phone. It's not that easy to just, come up and make those things in the U.S. I mean, they've been trying to perfect that over a 20-year period across different parts that they get from China, the factories that employs, hundreds and thousands of people. It's just not easy to move those. I think they will be pushing a lot more on the R&D front over here, hiring more local workers to offset some of that, which means at least over the next few years, there could be some downward pressure on their gross margins, in order to, showcase that they are investing heavily in the U.S.
How has it been like as an analyst covering all the tariff flip-flops and all these big tech companies that are at the mercy of some of Trump's pronouncements that are sometimes really unexpected?
I mean, really, listen, it is very tough. And frankly, we're going to see how and if this leads to some kind of demand destruction on any of the, end markets we cover. So far, it doesn't look like it's having an impact on the cell phone market. It doesn't look like it's having an impact on the cloud market. But when you look at something like consulting market, I mean, it is having a second degree impact because people or companies are not sure how they're going to be, what kind of economic environment they will see down the road, whether there'll be a recession or not. So there has been an absolute stop in a lot of the consulting work and a consulting related, bookings or contracts out there. And I think that's kind of what we are seeing, at least in the overall tech space right now.
Anurag, thanks so much for joining us. Always appreciate getting a couple of minutes of your time. Anurag Rana, he's a senior technology analyst for Bloomberg Intelligence. He and Mandeep Singh kind of lead our global technology research. It is a global technology research team. We've got analysts on the ground, North America, Europe, and most importantly, Asia, given where that is in the supply chain there. So Anurag and Mandeep manage that business for us. What are you looking at?
I'm just really I'm surprised because imagine Apple, you're a big company,
Yep.
$1 trillion market cap. And the president said shift out of China. So you do that and you go to India. And now they're saying, why are you in India?
Right.
And I just don't want to be Tim Cook right now.
Yeah, it could be a tough situation, but all companies are dealing with and trying
That's
to
fair.
adapt. And one thing
Exactly.
Tom Keene always says is companies adapt, whether it's a global pandemic or whether it's trade tensions, companies adapt, consumers adapt, and that's arguably what the tech industry and global trade will do as well.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.